welcome. You're watching Market Wrap, and joining me is Mr. Pankaj Pandey, Head Research, Icicidirect, to talk on the trend in the equity markets and outlook for coming week. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon, Gitu.
Pankaj, this week overall turned to be good. Sensex Nifty logged longest stretch of gains in over 30 months, 9 straight days of gains. Sensex finally ending this week at above 60,400, Nifty 50 above 17,800 levels. Do you expect market to take a breather around these levels, or will the recovery continue at the pace it has been happening as FII is now turned buyers?
So, Gitu, like you highlighted, we have seen about 1,000 points kind of a rally in 8 or 9 odd sessions, and so this is one of the strongest rally which we have seen since December of last year. And I think there are some things which are sort of helping the market sort of do well. One, I think the domestic inflation is lot good, so which is why the interest rate sensitive sectors, especially like auto and real estate, have done well this week. And also, pharma has been a beaten down sector, so we have seen some bit of a revival there. But since the markets have rallied swiftly in a very short span of time, so from a oversold kind of a situation, it is slightly mildly overbought kind of a situation. So we would
Okay.
want to sort of believe that probably at current levels, probably markets will consolidate, but don't expect it to sort of go down below 17,500. So 17,500 again, we would expect buying to sort of emerge, and eventually
Okay.
market should head towards 18,100 kind of a level. That is the level which we have been even talking last week also.
Right.
Because overall setup for the Indian market remains a lot better compared to what you see global counterparts. In fact, this week we have outperformed most of the major markets. And I think, so from that perspective, I think the overall positive bias should remain intact. And I think we've seen even the breadth is also good. You have
Yes.
most of the stocks in the S&P 500, so they're trading above their 50-day moving average. So from that perspective, it's a very broad-based move what we've seen in the market. And FIs have turned slightly positive, largely because you really do not have major brighter spots globally. So that is also sort of helping our markets.
Pankaj, talking about inflation, we had US inflation numbers which were in line. We had domestic inflation numbers which were above expectations because it was a cool off, a huge cool off in inflation numbers as far as India is concerned. So, how do you expect these numbers to pan out? And do you expect anytime soon central bankers coming forward and saying that okay, this is it now, no more hikes, and we'll start cutting now?
So in the US, I think the challenges are still sort of continuing because while their inflation is on expected lines, but the Fed commentary overall has been quite sort of hawkish. So I think there is very little leeway one can expect in the US market. So there is a now 70% chance of a rate hike again in the month of May.
Okay.
So US will continue to remain in a challenging situation because while there is an expectation of a lower growth this year, the inflation projection is still also high. Now, compared to that, or domestically, if you look at RBI has been sort of looking at an inflation of 4% plus two or minus two. And we have already gone inflation below 6%. I think some of the inflation, which is largely still sort of playing out, is the cereal part of it, especially the wheat prices. Wheat prices have corrected, so our sense is that that will also sort of soften further. And then you have spices prices also sort of inching up in double digits. So some of
Okay.
these, if they cool, so our sense is that inflation for us is not a big challenge because you are already at 6.5% repo rate. RBI is guiding for 5.2%. So even if the Fed were to remain hawkish for the rest of the year, our sense is that at best we might not see any kind of a rate cut. But if the inflation in India further softens, then I think we would get a decent number of ample room for rate cuts. So there is a
Okay.
policy divergence or decoupling expected to happen, especially when you sort of look at from US perspective and compared to what you see the domestic macros. I think this is very much on the cards given the recent inflation numbers which have come out.
Pankaj, Q4 earnings have kicked off. We had TCS coming out with the numbers. We had Infosys coming out with numbers. How do you expect the Nifty earnings to be for Q4?
Well, to start with, TCS numbers were sort of okay, bit muted. I think Infosys numbers were quite. I mean, they missed on the overall guidance for growth. So Infosys numbers were are a slightly bit worrisome. Now, coming
Okay.
to sort of Nifty, overall, our sense is that Nifty should witness about 15% kind of a aggregated profit growth, while the top line growth could be high single digits. But you will see a lot more better bottom line growth. One, largely because the banking and financial services sector that is going to sort of anchor the overall earning growth. IT
Okay.
also will do well because you have seen about 9% kind of a currency depreciation and 7 to 8% kind of a overall dollar revenue growth. So from that perspective, IT also is going to sort of contribute. And then auto is another sector which is going to sort of do well because compared to last year, the volume growth has been about 20 odd percent. So that is also going to help. So
Okay.
overall, our sense is that Nifty will witness a good set of numbers this particular quarter, 15, 16% kind of a bottom line growth. Top line growth could be in single digits. And nothing major to sort of complain from the result expectation per se in Nifty.
And one of the sectors which has been doing well and which is expected to do well is the banking space. It's strong business momentum in whatever commentary that they have come up with till now. So, how do you expect this sector to really pan out during earning season, and which are the best picks that you would focus on?
So in banking, credit growth continues to remain very strong at about 16 odd percent. That is for the coverage universe. 15% is for the overall banking as a pack. NIMs are again expected to remain at elevated levels, so no major challenges there. I think the gross NPA is expected to decline by 10 to 15 odd bips. I think if we sort of exclude the Citibank related amortization cost, which Axis Bank will have to bear, then the profit growth for the banking as a pack will be 36 odd percent. And from the company specific perspective, I think SBI is expected to deliver one of the best growth in terms of 15% kind of a growth. Bottom line growth for them could be even more higher at 65%. So Bank of Baroda and State Bank of India are expected to deliver a lot more better numbers on a YY basis. And those are the preferred picks at this point in time in banking space.
Why is it that you are away from the private banks this time?
Well, largely when you sort of look at, we have been liking HDFC Bank for quite some time, but we've seen decent amount of uptrend in the stock. So we will sort of revisit our targets for the bank once the result season is sort of over. Till that time, there is not much of an upside left. I think PSU banks have to do a lot more catch up in terms of pricing, so which is why PSU banks.
Correct. Talking about the capital goods space, order inflows have been, buoyant. I mean, every day we have new orders flowing in for these capital good companies. So, how do you see this sector panning out, and which are the counters and the companies that you think are going to deliver as far as the numbers are concerned?
So, like you rightly highlighted, order inflows are on new high. So we expect this segment also to sort of do well. So top line growth could be about 10%, bottom line growth could be about 6%. But I think while the numbers may look soft, but one needs to sort of segregate because when you look at, say, EPC companies, we would expect about 14% kind of a revenue growth and 17% kind of a bottom line growth. Similarly, product companies, about 14% kind of a revenue growth. The numbers overall looking soft largely because you would expect defense stocks to sort of do a top line growth of 2.5%. Mind you, defense stocks have already done well. Their execution has been very good in the last 9 months. Q4 is little soft for them in terms of execution. Otherwise, whether you look at from order inflows or whether you look at from most of the cut or most of the data variables, I think this sector is going to deliver a healthy set of numbers. I think what we prefer is something like L&T. Order book growth is expected to exceed 15%, which is what they have guided for. And top line growth could be over 12% and bottom line growth would be 17 odd percent. Thermax is again another company which should do a lot better in terms of bottom line growth of 47%, largely because Earlier, they were executing only low margin orders. So now that has sort of already been executed. So high margin orders is going to sort of lead to margin expansion and better profit growth. And some of the companies like, say, AI engineering will witness good growth. So there we are expecting about 40% kind of a bottom line growth. Something like LG equipments, again, high teen kind of a both the top line and bottom line growth. So I think this sector has been sort of doing well, both price wise, number wise. We don't expect much of a disappointment coming from in most of the companies what we track.
Mhm. What has changed for pharma space, Pankaj? I remember, if we talk about some weeks back, we never preferred pharma as a bet, and now things have changed. In last 2 weeks, we are seeing some bit of attraction and some bit of interest coming back to this space. How do you like this space?
So one is, I think pharma is a clear sector which is benefiting from the sector rotation because this was the first sector which did exceptionally well in 2020 when the COVID had stuck. Now there is some bit of an increase in COVID cases, so people are now realizing that there is a sector called pharma now. But what we have been seeing is that there have been sort of improvements happening in the pharma as a overall space. So, for example, in this particular quarter, we would expect overall our coverage universe to deliver about 11% kind of a growth. Again, of that, 16% of the growth will be driven by US. Now, US is one territory which has been impacted for most of the companies, but now companies have recalibrated their growth plans. So they are focusing on complex generics, which has got a better margin. And then India business continues to remain stable at 12, 13% kind of a growth. So which is where I think somewhere down the line. And then export data has been sort of healthy for some of the companies. And that sort of led to pharma as a sector sort of doing well this particular week. But having said that, because US is doing well, domestic is sort of doing okay. So our sense is that you will see margin improvement for this segment to the tune of about 300 bips, and that sort
Okay.
of that should lead to a good bottom line growth of nearly 25, 30 odd percent. So you're going to see one of the strongest growth for pharma in this particular quarter. And mind you, I mean, both Sun Pharma, again, high teen kind of a top line, bottom line growth. Similar is the case with the DRL, even for SIPTA. So most of the companies are expected to deliver high teen kind of a top line and bottom line growth for this particular quarter. So yes, benefit of a better set of numbers plus overall revival in terms of sentiment. So I think that is helping pharma to sort of do a bit of a catch up.
Very true, and we saw a very good momentum in some of couple of the good pharma names. Coming on to the FMCG space, Pankaj, we have raw material prices for FMCG companies coming down. We had some price cuts from biggies like HUL, and then we have some bit of a respite as far as the rural demand is concerned. But again, when we talk about El Nino, deficit monsoon, we be a little cautious on this sector. So, how do you play on FMCG names?
So in FMCG, last 18 months, what we have seen is more of a pricing driven growth and volumes had taken a back seat. But now, since a lot of these commodities have corrected, now volume growth is sort of coming back, and which is what we would say see for companies like HUL. So that is expected to deliver some 15% kind of growth, and so volume growth is expected to be 6%. Pricing is still higher at 9%. And I think something similar is what we would expect even for ITC also. So ITC cigarette volumes are normalizing, so you'll see 13% volume growth there. Typically, normalized volume growth is 4-5% unless the taxation is not tweaked so much. And then I think you're seeing higher growth in food, discretionary and stationery segment. But sum total, FMCG will deliver high single digit kind of a growth and bit of a margin expansion. But beyond that, I think the bigger challenge for FMCG as a sector is not the numbers, what they'll come out. I think the kind of announcements you are seeing from a big player like Reliance entering into various segments,
Right.
you are seeing a lot more players entering into the segment, and which might cap margins or which might cap multiples, which and a combination of that can produce more of a time correction, if not price correction, for a good period of time.
You spoke about Reliance entering into different businesses, and now they are into dairy products also. They have entered not recently, a couple of years back, but now they are giving a big push for dairy business, and we saw milk prices skyrocketing, and that has become a reason where we now talk about milk prices really reflecting onto the inflation. So, what is your take on that? Why is that milk prices are soaring, and do you expect that to be a cause of concern and that have an impact on inflation?
No, I think so. Milk prices. So one is obviously the input cost is also going up. But of all the agri commodities, if the prices of milk increases, I think that has a biggest positive rub-off on the end farmer. Why? Because when you look at any particular crop, say for example potato, the realization to the farmer is at 15 to 20 odd percent. But in case of milk, so if you are sort of buying milk at say 50 rupees, 60 to 70% of that realization is actually goes with the farmer. So it's very remunerative for the farmer. So from that perspective, it's socially important that milk prices actually sort of keep on stable. But
All
having said
right.
that, we are seeing some bit of impact on inflation. But see, our CPI basket 50% is largely agri-related products, so you continue to see this some kind of a volatility there. And so from that perspective, I don't think milk prices increasing is a bit of a worry. But yes, companies like Reliance entering into dairy segment obviously poses challenges for companies, say for example Nestle, which has got a business that side, or a number of other companies. So that way, it's a bit of a challenge for some of the players in terms of how they would sort of manage the evolving dynamics.
All right. One of the best sectors that you have been talking about is auto. How do you expect the numbers to pan out for auto space this time?
So auto again is expected to come out with an extremely good set of numbers. So we are expecting about 7% kind of a quarter-on-quarter growth and profit growth of 9 more percent. Now, most of the margin expansion is largely sort of played out. We would not expect margins to sort of increase. But our sense is that the ancillary as a category will witness a lot more better margins, especially the tire companies. And that is why we believe that the ancillary as a space will witness, while the top line growth could be 4 or 5 odd percent, but margin expansion could be about 120 odd bips. So from that perspective, overall auto as a space is expected to come out with good set of numbers. We're extremely gung-ho in terms of Tata Motors coming out with a good set of numbers. One, I think their sales growth has been 10% quarter on quarter. JLR sales volume is up about 16 odd percent. And then I think on the CV side also, the mix is sort of turning better. Same is the case with Ashok Leyland. So Ashok Leyland has seen a good amount of 26% jump in sequential volumes. And the medium heavy commercial and LCV mix is better. So we would expect for their profit to sort of grow in almost doubling, something similar even with Tata Motors, because they were making losses last year. And Apollo will come out with one of the best set of numbers, especially in terms of margin front. So that is another company. So I think auto overall good set of numbers, but Tata Motors, Ashok Leyland, and Apollo Tires are expected to come out with the best set of numbers.
We have a longer weekend this time, Pankaj. Are you going out somewhere?
Well, that depends on my wife, but usually hotel industry is something which has been in the bus for quite some
Yeah,
time. So
I
it's
didn't
a, it's
find
a
any
sort of a
reservations actually.
so it's a weekly ritual to sort of go out and have dinner. So coming specific to that, so for hotel as an industry, we are expecting about 10% kind of a ARR jump. Occupancies are better because occupancies have improved to 68 odd percent. While numbers might look soft on a consolidated, because the international operations for Indian hotels might be slightly soft because Q3 is a very strong quarter there. But when you sort of look at a pure domestic player, something like Lemon Tree, you will see high single digit kind of a quarter on quarter growth in top line, bottom line, as well as margins. And overall, our sense is that this is one space where strength is still sort of continuing across. We don't see any kind of a structural issues cropping up anytime soon. So I think again you will see companies like say Lemon Tree coming out with one of the highest set of margins. Plus, most of these companies are now sort of looking to expand through management contract, which
Right.
again also means is that your balance sheet is not going to get heavier. So I think all the companies in this space are sort of placing themselves very well.
Cement, how do you expect the cement numbers to pan out? We had seen good realizations this time.
So cement will benefit largely from the fact that the utilizations have been better. So utilizations have gone up from 80 to 88 odd percent. Pricing growth hasn't really sort of happened. So since the utilizations have gone up, our sense is that you'll see an overall EBITDA per ton improvement of over 170 rupees per ton. So from that perspective, bigger companies like say Shree Cement or Ultratech will report EBITDA per ton of about 1,000 rupees per ton. I think the best is yet to sort of come for cement companies because one, the price hike is expected, so that should benefit post Q1. And then even the coal prices, which have corrected by 30 odd percent, since companies carry some bit of inventory, so the benefit of that also will sort of should play out in subsequent quarters. So while you will see an improvement quarter on quarter, but I think the best is yet to come for cement. But like I said, you are seeing an improvement at least on quarter quarter basis with tier one names like say Ultratech Cement or Shree Cement.
What do you like in oil and gas space as far as the earnings are concerned?
So oil and gas, largely, see, from a top line perspective, it would be sort of muted for most of the players. But margin profile is something we would expect for most of the players to improve. See, for upstream companies, since the realization is capped, so you don't see much of an impact on top line. But you will see bottom line or EBITDA improving for most of the players by good numbers. Largely because the marketing spreads have improved. But what we like the most is again Reliance because I think Reliance is preferred for various number of reasons. One, I think on the oil to chemical front, the refining margins are expected to be good, so that should lead to 11% kind of a quarter on quarter growth there. While petchem could be a bit soft, but refining margins overall are good. Then Geo is going to post okay set of numbers. Because but their subscriber addition has been good, so from that perspective is also decent set of numbers. I think Reliance Retail is expected to post about 20% kind of a growth a YY basis because they've done one of the highest addition of stores. So I think Reliance, a combination of various business, looks the best in oil and gas space.
Time for hidden gems. So, what's on your list this time?
So, what we have seen is that the gas prices have been sort of cooling off substantially. What I'm sort of highlighting is the beneficiary of the cooling gas prices, which is Kajaria Ceramics. Here, our target price is 1310 or 1310. Now, our sense is that with the declining gas prices, margin recovery is on the cards because what we have seen is that, see, this is one of the largest tile manufacturers in the country with a capacity of about 84.5 million square meters. They have already done capex of 250 odd crores. Further doing a capex of 125 odd crores. That should add another 10 million square feet kind of a capacity in India and Nepal put together. Now, normal margins for this company is about 16 odd percent. Peak margin was 18%, but now margins had come down to 12 odd percent because the gas prices had gone up. Now, our sense is that next quarter you will see margins improving from 12 to 14 odd percent, which is in Q4. And subsequently, our sense is that this margin will again get normalized by FY24. So our sense is that overall, from current levels, you will see a good margin improvement over the next 2 years. Now, we are expecting about 15% kind of a volume growth, which is what the company has guided, and that should translate into 18% kind of a top line growth and a good profit growth. So from that perspective, this company looks good to us with a target price of 1310.
So, hidden gem for this week is the Kajaria Ceramics for 80% upside. So, Pankaj, we have a long weekend. You know whatever can something can happen over the weekends also. But how do you plan to play the markets next week? We have earnings. Will you be stock specific?
Absolutely. I think we have already seen 1,000 point of a kind of a rally in Nifty. So our sense is that Nifty should consolidate around with lower levels of 17,500 to higher levels of 18,100. But since we are entering into a result season, so I think it is better to play more of a stock specific. And typically, result season you'll see more of stock specific moves. So our sense is that one should focus on key companies where the result expectation is being better or where there can be an element of positive surprise.
One last question. Are you still sitting on cash or you're fully invested?
Sorry, I didn't get the question.
Pankaj, are you still sitting on some cash or are you fully invested?
So what we have been advising people is that when you sort of look at Nifty levels at 17,000 odd kind of a levels of below that, we were trading at 15 and a half times, which is the 10-year average P multiple band. So that was the level to sort of go or do more of lump sum investment. Now with markets have improved, I think this is the time for SIP kind of investment. If somebody is looking for a lump sum, then I think probably the waiting period needs to be 2 3 years because last 15 or 18 odd months we have not seen Nifty making any or delivering any kind of a return. But I think next 15 16 months, our sense is that with US Fed turning softer, which is what the expectation, and domestic macros largely remaining intact, possibly we might get one of the best returns in the Nifty over the next 2 years. And which is why anything below 17,000 can be a good lump sum opportunity. Otherwise, SIP kind of a mode of investment, depending on individual risk profile, I think is a better option.
Thank you so much, Pankaj, for your time.
Thank you so much.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.